Welcome to the next in the series of these series of videos on misconceptions about options, or a little extra, I don't like to say tricks, but some things that people don't totally understand, and especially for beginners. So if you're a more advanced trader, you'll probably understand some of this stuff, most of it. We're going to be talking to beginning traders. I want to protect you guys. That's what I'm trying to do here, is protect you against a lot of the common misconceptions out there. So in the last video, we asked this question, and that question was very simply, is selling options better than buying options? Because that is one of the things that's hyped out there a lot, because they say, oh, the most options expire worthless, and that is just simply not true. We demonstrated that in the last video. Doesn't mean you can't sell options and make money, just means that you can't go by that premise. That premise will lead you astray and mess you up. So today we're going to ask the opposite. Well, is buying options better than selling options? In fact, after that last video, a lot of you sent me emails asking this very question. So, what is the answer? Well, the answer is for home run opportunities. In other words, if you want to make the big money, have some big wins, then the answer is definitely yes. When you're selling options, then you can create a nice, steady income. It's really great for that if you know what you're doing. And hey, income is great. I love income. Who doesn't, right? Have that nice, reliable, weekly, monthly income. So that's great, and I pretty much do that all the time. But I gotta tell you, it's really nice to get those big windfalls every once in a while. And buying options is the way to do that. So let's talk about that today, so we can get you some big wins in the process while you're collecting income. Now, as always, there is a problem with buying options. So there's always problems. And there, man, I wish I could live in a world without problems, especially a trading world. Well, the problem is, it really comes down to this. You got to be righter. And righter is not really a right word, but what the heck? You know what? I think I'll pull out my dictionary and I'll just write it in, and then I can say it's in the dictionary. But that's a big problem, because how many of you are right with most of your trades? Just normally. And that is a problem. If you're not, then you're going to have even bigger problems with buying options. Because when you just buy a stock outright, you're starting with a break-even on your position. Okay? On the other hand, when you buy an option on the stock, you're not starting out at a break-even on your position. Because you're not buying the stock, you're buying a contract. You're buying the right to buy the stock at a future date at a future price. And you get a lot of leverage for that. You get a lot of benefits, but those benefits cost. And that cost is called a premium. And so you're putting up that premium, and essentially you're starting with a losing position, unlike buying a stock. So we'll put up a little graph. Don't you like my nice hand-drawn risk graphs here? I'm just doing some real basic, simple ones, because I'm just trying to get basic concepts across, and I think it's simpler if we use just some even numbers here and make it clean and not confuse it with a lot of other stuff on there for the purpose of this video. So if you buy a stock at $100 a share, okay, you're breaking even immediately at $100, obviously minus trade commissions, expenses, fees, and all those goodies. Now, if you buy a $100 call option, in other words, your strike price is $100, you got to pay something for that, and you're going to pay, well, let's say pay $5. Again, I'm just going to use even numbers for easy math here. And so what that means is that if you want to then sell that stock, or you want to sell your option and buy the stock, exercise your option, so to say, at expiration. And by the way, this risk graph is based on expiration dates, so that's another thing we can look at in the future, is the element of time. But just for clarity's sake, that stock has to go up to $105 for you to break even. Why? Because you paid $5. And that money is not coming back unless, obviously, you sell the option beforehand. But if you exercise the option and decide to buy the stock, it's got to go up to $105 just for you to be at a break-even point. That's because options have extrinsic value. Intrinsic value is what is built into the stock price itself. So if you're buying in the money options, you're going to have intrinsic value. But otherwise, you're not. or you're going to have a mix of them. So extrinsic value is based on the expiration date and a bunch of other stuff. Here's the bottom line. You got in the money, at the money, and out of the money options. Again, at the money means that if the stock's trading at $100, then you buy a $100 strike price, and so it's at the money, at the price. And your risk graph will look kind of like this. These are called risk graphs, by the way, in case you don't know. And so, you know, as we show this, you've got the at the money blue line, and it is going up, and then to the left it goes sideways. So that's actually a very, very important point, because this is part of the benefit of options as well. So with options, you are limiting your risk. They help you to manage risk. In fact, they're actually created to manage risk. So you see how it goes flat here? So if you bought this at $5, then $5 would be your maximum loss. The most you could lose is the amount that you invested in the price of the option itself. Whereas if you were to buy the stock outright and just buy the stock itself, buy the shares, then the risk graph would look like what we already saw. And this would just continue to go down here because, well, the stock could go to zero, and then you could lose everything. It could go all the way down to zero. So that's one of the benefits of buying a call. So you get a benefit in the fact that it minimizes your risk. But again, the market's always going to make you pay for any benefits that you get. Right now, so that's at the money. Let's compare that with, real quickly, in the money. So in the money means that you are, let's say, again, the stock was $100, and you're going to say, well, I'm going to buy a strike price of 90. So that gives me the right to buy the stock that's currently selling at $100, but I got the right to buy it at $90, less than it currently is, $10 less. Well, that sounds pretty awesome, and it is. Except the market says, well, we're not going to let you just flip this thing, and make $10 for doing nothing. No, we're going to build the price of that into the price of the option, so you can't just flip it and make money right away. And yeah, that's going to be built into the option, along with some other variables, which we'll look at in a minute. So in the money options, the nice thing about them is that you're going to make money sooner, so the stock doesn't have to go up as much. Compare the in-the-money option with the at-the-money option. Okay, and this is as prices go up, 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 up. So the price of the stock doesn't have to go up as much for you to start making some money on your option as it does at the money. Now, it's going to cost you more, because now you have intrinsic value. In other words, the price of the stock at $10 that you're already in profit, so to say, that's built in to the price of the option. So you're really not in profit, because they're going to make you pay for that. In addition, because you're spending more money on the option, your risk is going to be bigger. Again, the risk being the price of the option that you pay. And so in the money, yep, you make money sooner. Stock doesn't have to move as far. You don't have to be as right, as soon, as fast, and as much. But it's going to cost you more. Your risk is bigger than it is on a at-the-money option. Okay, well, golly, why don't we look at an out-of-the-money option? And a lot of people love out-of-the-money options, especially beginners, because they're cheap. And not because the people are cheap, but because the options are cheap. And so that's one of the big attractions, and this is one of the things I want to warn you about, because some people who have very small accounts, they're the most vulnerable to getting hurt, right? And they can't afford to get hurt. And so this is one of the main reasons for me creating this video, actually, is I want to warn you about this. It all sounds well and good to say, oh, look, you can get in for a very, very little amount of money, and out-of-the-money options are cheaper. In other words, out-of-the-money option would be, if the stock's at $100, you would say, okay, I'll buy it at a strike price of $110. So now you have no intrinsic value whatsoever. It's all extrinsic, and therefore you don't have to pay for, the money that's already inherent, if you will, in the stock price or in the option stock price. So you get it for cheap. And people with small accounts are attracted to things that are cheap. But again, that adds risk. The reason that the pricing model allows you to buy it for so cheap is because your odds of making any money are much, 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 much lower. So the price of the option is going to have, or the price of the stock actually, is going to have to go up to here, as opposed to at the money where it only has to go up to here, as opposed to in the money where it only has to go up to here. So, yep, risking less, right? If you do take a loss, it's going to be less. Price is less. You can get in for less with a smaller trading account. But your odds of actually making any money are not nearly as good. Not nearly as good. And again, obviously, there's many, many nuances to this. But that's just the big sweeping thing that I wanted to share with you. So to summarize it up, in-the-money options are more expensive, but the stock doesn't have to move as much for you to profit. At the money, medium expense, kind of medium move to start to make some money. Out of the money, cheap, so attractive, but the stock's got to move a lot. So if you are not very good, your history hasn't been good at predicting big moves in the market. In fact, you can't even make money on little moves. Out of the money options are probably not going to be too bueno for you. It's going to be really hard for you because you are going to be wrong most of the time. And so, yeah, you'll lose less, but you're going to lose it almost all the time. And that adds up. So premium. Premium is the extrinsic value of the option. This is basically the difference between the price of the stock and the price of the option. Now, I said that there are some other nuances to this beyond just what the strike price is and what the price of the stock is. So again, we can't go into all the details, but I just want to give you a couple of quick overviews here. Number one is theta. So theta is time decay. Again, it has to do with probabilities and risk. So the more time that goes by, because options have an expiration date, they don't go on forever, right? There's an expiration date and then you're done, you're toast. If you don't do anything with it, you just lose all your money. So the more time that goes on and the closer you get to your expiration date, the less likely it is for the market to do what you want it to do. There's not as much time left for it to accomplish what you want it to accomplish. You know, if you buy a stock today for $100 and you buy a strike price for $200 and it expires tomorrow, it's not likely it's going to go up 100% and double in 24 hours. It's just very, 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 very unlikely. So theta is very important, and it is the seller's best friend. So if you're going to be an option seller, theta is a beautiful thing. And normally what you want to do is sell options that are going to be expiring sooner. Less than 30 days is ideal. 60 days, okay. Not more than 90 days, because there is an exponential curve, a parabolic curve that occurs on that theta decay line. So it's not linear. Like we saw those straight lines, that's not how theta works. Theta works on a curved line, and the closer you get to expiration, the more theta comes out of the market. And so this is why sometimes people wonder, well, hey, I bought this option and, you know, the stock went up, but the price of my option didn't go up. How come? Because the price of the option is not immediately and correlated on a one-on-one basis to the price of the stock. There's other factors, and that's what these are. These are called the Greeks, by the way. And theta is a big one. So if there's only 2 days left in that option and the stock goes up and your option doesn't go up, well, one of the variables could be it's because, well, there's no more theta. You paid for theta. You pay for theta. You pay for time in the premium. And that value gets less and less and less and less. So that's really the buyer's worst enemy. So usually when I buy options, it's 90 days or more from expiration. Now, delta is one of your best friends as a buyer. Delta is the speed at which the option price is expected to move for every $1 move in stock. So again, the stock and the option do not necessarily move in a one-to-one correlation. So how do they move? You want to know that. You want to make sure that if that stock moves, your option price is going to move as well. So delta is one of the things you want to look at. And so basically you want big delta. You want the price of the option to move a lot when the stock moves. And then gamma comes in, and gamma is a beautiful thing. So gamma is the acceleration of the option's price. It's not just the speed. Okay, to understand the difference between speed and acceleration. This is one of these little, it's not a secret. Everybody who trades options knows about gamma. But for those of you who are new, you really want to look at gamma if you're a buyer, because it's the acceleration of the option's price. You want it to move faster. And actually, you got to know delta first, because gamma is the rate at which delta will change based on a $1 change in the stock. So again, we want big gamma. Okay, we want that option price to really take off and move a lot. So here's a good combo for you. Again, not a complete list, but a good place to start. So if you're going to buy options, again, because one of the value of options is that we get leverage, we can spend less money, invest less money, to control more stock. You can, and when you get into the high price stocks, it's going to cost you more money, and buying options generally costs you more for various reasons. But the low price stocks can keep you into an area where if you don't have a large trading account, which most people don't when they're first coming into trading options, low price stocks will be lower priced options. However, as we talked about in the last video, you got to be careful of that, because if they're low priced, and I mean really low priced, like penny stocks, then they can be manipulated and so forth. So you've got to combine that with good volume. And by this, I mean good volume in the stock or the underlying market. Could be a commodity, forex, whatever, futures. But you want good volume there so that there's professional involvement, systematic trading, orderly trading, intelligent trading behind it, and not just based on the emotions of amateurs, which can whipsaw the market around, or pump and dump schemes. You want favorable Greeks. We just barely touched on that a little bit today, but that is, I won't say your secret sauce, but it's a very important sauce. It's what gives options their flavor, if you will, on the plain noodles. Okay, I just came up with that little lame analogy on the spot. So you've got to understand that. That is really where your leverage is applied in options. And if you don't understand that, you are toast. That's another, a Greek is toast. And then, and this is so important, and unfortunately not emphasized as much as I wish it was in the options world. You need to understand the underlying chart, or the chart of the underlying market that you're trading. Options are derivatives. They're derived from something else, usually stocks in our references here today. And so you've got to understand the movement of the stock before you even look at the derivative or the option. So I never encourage people who come into the trading world for the very first time to start with options. I always encourage them to start with learning to read technical analysis of stock charts, because that's what's going to be your first step. You want to, in this case, for buying options, you want to find a market, a stock, commodity, futures, whatever it is, that is set up in a technical analysis way for explosive moves. Because again, we got to have these puppies move, right, when we're buying. And so you've got to be able to identify patterns where they're going to really take off. So some examples might be, contraction patterns, consolidation patterns, triangles, wedges, Bollinger Band squeezes, things like this. So where we're looking for a contraction of volatility and then to change into an expansion of volatility. That would be one example or several examples of the type of condition that we'd be looking for buying options. Okay, well, this was a long video today. I didn't think it would be this long, but you know what? There's a lot to say, and there's so much more. Please, in the name of all that is holy, do not go trade options until you really understand that. But we all have to start somewhere. And so I'm just trying to give you some basic overviews here, some things to be aware of, and maybe a couple little tips that you might not hear elsewhere. They are great instruments. I love them. They're my favorite market to trade. And so I think it is worthwhile getting educated about it. Just make sure you do get that professional education, because they do come with risks, and you need to be very aware of those risks. But Once you become aware of those, for my money, it gives a combination of the ability to make the most money the fastest, a nice steady income in combination with those big wins, and a great lifestyle. You don't have to sit in front of the monitors like a day trader and sit there and watch every tick of the market all day long, which, let's face it, most people can't do that anyway. You can trade options and have a full-time job, or not have a full-time job and have a great lifestyle, have a lot of time freedom. And I just think it has the best of all worlds. So anyway, speaking of understanding the underlying market, I have a wonderful trade strategy that I give away for free called the rubber band trade. This is based on the underlying market. You can actually use this for stocks, forex, futures, commodities, options, day trading, swing trading, because it's a pure technical analysis trade setup. And it works beautifully, has a super high win-loss ratio, and I'll be happy to give that to you for free. You can click in the link in the description below, or you can click on the little image in the top right corner of the video, and that'll take you to the page where you can tell us which market you trade, and we'll send you the appropriate video.